International ETFs. Should you invest outside the US? Most Americans have never invested a single dollar outside the United States. And that might be costing you hundreds of thousands of dollars in retirement. I'm about to show you exactly why the biggest money moves in 2024 aren't happening on Wall Street. They're happening overseas. Hey, welcome back. If you're new here, I'm the guy who breaks down wealth building so it actually makes sense. Hit that subscribe button because what I'm about to share changes how you think about diversification forever. Let's start with the uncomfortable truth. Part 1. The problem with US-only investing. Right now, the United States represents about 60% of global market value. 60%. That sounds dominant until you realize that means 40% of the world's wealth creation is happening somewhere else. Japan, Germany, Canada, Australia, India. These aren't tiny markets. We're talking trillions of dollars. Here's what happens when you ignore this. You're essentially betting your entire financial future on one country, one economy, one set of regulations and policies. Think about it this way. If you work for one company and own stock only in that company and live in that company's town, that's not diversification. That's concentration risk. And it's exactly what Americans are doing with international investing. According to data from Vanguard, the average American investor puts about 95% of their portfolio into U.S. markets and only 5% internationally. Meanwhile, financial advisors at firms like Fidelity recommend international exposure of 20 to 30% for most people. Let me give you real numbers. If you're 25 years old with a 40-year timeline to retirement, missing out on international returns could cost you somewhere between $200,000 and $500,000. Depending on market conditions. That's not hype. That's math. Part 2. Why international ETFs actually work. International ETFs let you invest in entire countries or regions without picking individual stocks. You're basically saying, I believe in Japan's economy, not I believe in Sony specifically. The biggest international ETF in America is VEA, Vanguard FTSE Developed Markets. It holds over 3,700 stocks across 23 developed countries. One fund. Over 3,700 companies. That's instant diversification across continents. Then you have VXUS, which is the whole world except America, Japan, UK, Australia, Canada, France, Germany. It's all in there. Buy one fund. Own the entire global market outside the US. Here's the thing nobody tells you. VXUS has massively underperformed the S&P 500 over the last decade. I know, this is where people get confused. But here's why this actually proves the point. When something underperforms for a long time, it's either about to catch up or it's genuinely broken. Most academics believe it's going to catch up. Why? Because valuations. American stocks, especially tech stocks, are trading at historically expensive valuations. International stocks are cheap right now. That's the whole point of diversification. You're buying what's out of favor so you profit when it comes back into favor. You're not trying to beat the market. You're trying to own the market. All of it. Part 3. How to actually start. If you have a Roth IRA, you can add international ETFs right now. Log into Fidelity or Robinhood. Search for VXUS or VEA. Buy it just like you'd buy a stock. Boom. You now own pieces of thousands of international companies. The strategy most financial advisors recommend is simple. 70% S&P 500, 30% VXUS. You get American growth. You get international diversification. You sleep well at night knowing you're not betting everything on one country. If you're younger than 35, you could even go 60 US and 40 international because you have time to recover from international downturns. Your 401k at work probably has international options too. Check your plan document. Most do. The only people who shouldn't invest internationally are people who plan to spend their entire retirement in cash or people who only believe America will outperform forever. If you're building long-term wealth, international exposure isn't optional anymore. Call to action. Start small. Add 10% of your next paycheck to an international ETF. See how it feels. Most people discover they don't notice the difference, but they notice the diversification. Drop a comment below. Are you already international? What's holding you back if you're not? I read these and it helps me make better videos. And subscribe. We break down wealth building every single week. And you don't want to miss the next one. Build wealth outside the US. Your future self will thank you.